Today, we're going to answer a question, that a lot of our clients have asked, and I'm sure is very popular out there if you just take a look at the web questions, Google questions that are being asked. And that is, how do you pick stocks? How do you decide which stocks to invest in? To answer that question, what I wanted to do is I wanted to bring one of our senior advisors on screen with me, Chris Saraganian, who happens to also be a member of the investment committee. This is one of the guys that lives, breathes, eats, sleeps this question to answer on behalf of our clients. So I thought the best thing to do is I'll pose the question to him and let him kind of tell us what's the secret sauce. How do you, Chris, pick stocks?
Well, thanks, Greg, for bringing me in today. Me personally, the way I pick stocks is I have two sets of darts in my desk.
Okay.
One with green tips, one with red tips. Use the dartboard in the middle of the office.
And you're doing this yourself, not the monkey. You don't have a monkey doing it for you. You
No.
Technically are doing it.
It's pretty accurate buy-sell decisions. But
Very cool.
For someone that might want to take a little less random approach to that.
Okay. Let's.
The end goal here is to pick the stocks that are going to be worth more at the end of the year than when you bought them at the beginning of the year. I'm saying a year here to narrow the time scope, but it's whatever time frame you're looking to hold or purchase these stocks for.
Simple enough theory. I want to own a stock that's going to go up from wherever to wherever within the period of time that I determine.
Yeah,
Can't be that easy.
You can't just pick one that goes up, right?
Okay.
If you buy a stock and you get it goes up 1% over the course of the year. I buy a stock that goes up 20% over the course of the year. You made a bad purchase per se because you could have put your dollars towards something that was more valuable or that gave you a better rate of return. It's not only about going up, but also the opportunity cost of what it can go up over the course of that period.
Any secrets to figuring out, let's just go back in the process. How do you, first of all, figure out what stock's going to go up?
Sure. So, first you have to decide what you're looking at. Currently, there's over 40,000 stocks or publicly listed companies globally. It's a ballpark estimate, but it's somewhere in that range.
Okay.
We bring that down to globally. We're looking at 10,000 companies. And then we can break it down even further. And let's just say all we're looking at is the S&P 500.
So that's 500 of the largest publicly traded companies basically in the United States.
Exactly.
Okay.
Exactly. So a lot of the ones at the top are the household names, the ones that we know. And then it goes a little bit further down, but we're talking about 500 of the biggest companies in the world.
And now, before we actually went on camera, you were telling me you had just looked at these numbers in preparation for this shooting. That what number of them had year to date actually lost money?
Sure. So we're looking at this in November of 2025, and it was almost half of the companies, just in this small subset of the biggest companies, have lost money since January 1st. I guess not the companies lost money, but if you would have bought a share of their stock and decided to sell it today on the stock market exchange, you would get less than what you put in.
Okay. Now, that's pretty easy to determine because you're looking backwards. I mean, it's pretty easy to just say, okay, from here backwards, 1 month, 6 months, or in this case, you went back a year and say, here are the ones out of the 500 that made money. Here are the ones out of the 500 that lost money in terms of the stock price. But you're not going to tell us that that's how we make decisions on how to buy stocks by just simply looking in the rearview mirror. It's more forward looking, right?
Sure.
But I'm sure there's some present calculations as well. Tell us a little bit about how you're really now looking at a stock. Let's say you've got a sense this stock might be the one. Okay, what are you really going to bore down in to figure out whether, that stock is the one you want to own?
Sure. So probably the best way to do that is you do start with backwards looking. That information's never going to change. It's always going to be right. You can look at the earnings statements for a company, how the stock has performed in the past, and you're not necessarily looking at those items because they have some predictive power But it gives you a foundation for which to establish, okay, how much money does this company make in a single year? And then here comes the more difficult part is from this point going forward, what do we suspect they're going to make in the future? Do they have new product lines coming up? Are they going to go into a new market? There are dozens and dozens of variables that would affect how you're trying to predict where this company's profits will be 12 months, 24 months from now.
And some of that, I would imagine, has also a lot to do with the sector they're in, or at least the industry they're in. I mean, they could be a very, very good company, but that particular industry is getting beat up, or
Right.
is going to become favored.
Right. And so there's kind of bottom up analysis, which is looking first at the companies. Do we think this is a good company? How have they performed? What are their earnings? How are they doing? And then we start looking at, okay, let's get a little bit outside of the company, but looking a little bit more at the industry. Is this the next, Kodak within the film industry, a dying industry? Or is this, at least currently, the hot topic, AI, something that's rapidly growing and evolving? So not only how is the company performing by itself, how is it performing within an industry? And then you start going out further from there, looking at more economies within the country and then globally. And so there's that way of looking at it as well. And you need to incorporate all of those factors.
Okay, so let's say you come up with a decision that a given company is going to be profitable. Mm-hmm. And let's assume you're probably right. Okay, because you've been doing, let's say you've done this a lot of years. We're going to assume you're right. Does that necessarily mean you're going to buy that stock? It's a profitable. It's going to be a profitable company. You just buy it at whatever price you possibly can.
Right, and so that's where that opportunity cost comes into play. You don't just want to buy something that's going to be profitable. You have to buy the shares of the company at a price where you personally will to be profitable. So a lot of the times what that involves is coming up with a future price target for a certain stock and then discounting that back to today. What would I be willing to pay for future profits from this company? So it's there's a very technical component to it, but a lot of it is also very up to the skill, or some would say luck, of a manager in determining those future looking price targets as well.
So you've got a profitable company, but what you're saying is based on the price of the stock of that profitable company, it could be undervalued or overvalued, and that would influence your decision. So it's laying one more criteria on that.
Exactly.
Now, we've heard there's a lot mentioned about sell discipline. So I imagine it's not just enough to be able to identify the company, know what price you're going to buy it at. You have to have some discipline in knowing when, if ever, to sell it. Talk a little bit about what that looks like.
Sure.
That sounds like it's the flip side of the coin on this decision.
Yeah, well, I guess it's easiest to pull from the most recent examples. So I was looking at one today, and it's Chipotle. I don't know if you remember, but they were on a tear several years back as far as it, went gangbusters. It was one of those top performers for a couple years as far as U.S. stocks. And I was looking at it today, and it's been, over the course of 10 years, pretty flat. So an investor who bought this stock 10 years ago saw it go up really high and then come down significantly. They've still earned a positive rate of return, so they haven't lost any money. But because of the recent downturns on that stock specifically, an individual investor would have made a lot of money getting out at the right time. So it was not only identifying the right buy opportunity, but also getting out at the right time. And so it requires two correct decisions.
Well, it sounds like, okay, whatever that time frame was, it sounds like it's probably a series of correct decisions because you won't know when that top price is unless you're almost every single day, and maybe it's not that frequently, but every single day, you're revisiting the first decision. You made the first decision that said, yes, I'm going to buy it. I'm going to buy it at $10. Well, you don't know to wait 6 months or 9 months or 2 years to revisit that. You probably got to make that with some degree of frequency and say, okay, I'm going to now look at it again 1 week later. What would I buy the stock at? So you're doing the very same analysis multiple times in order to determine where are we relative to making that decision to get out.
Exactly. And so, you want to be looking at that. Where are we from when I bought the stock? Are we up? Are we down? But that's actually an error that we see a lot of retail investors make, and that's anchoring bias.
Describe that a little bit more. What does that mean?
I bought the stock at $10. So I'm not going to sell it at $9. I'm going to wait for it to come back to $10 so that I don't take a loss. So it doesn't look like my trading activity is doing poorly. Chipotle is the example we're using here, but really any stock. Those executives, those people who own the company, they don't care when you bought the stock. They don't know what price you paid for it. And the fact that you bought it when you bought it has no actual bearing on that future price. You're anchoring to a point in your life that is, or
that's not relevant at all to the companies.
It's not relevant to the actual performance or the analysis of, well, I thought this was a good buy. I bought it here. I did the analysis back then, and I said that my target was going to be $15. I'm going to get out at a 50% gain. I'm not there yet, so I'm going to keep holding. I'm going to keep holding because I bought it at 10. I don't want to sell at a loss from when I purchased it. And there may be a point in time where that stock reaches $15. But if it took me 10 or 15 years to get there, I've missed out on being invested in so many other companies with those dollars that a 50% total return may not actually be that great after all when you look at the grand scheme of markets.
Well, you're also suggesting, I think, that there might be a time when you just have to take your losses. You have to make a decision. This stock, Chipotle, picking on poor Chipotle, is not going to make it up to where I thought it was within a reasonable period of time. And you're not just analyzing Chipotle. You're as a stock picker, you're analyzing all sorts of other companies. So I think what you're suggesting is if you decided, oh, you know what, Ford is now starting to get on a tear, it might make sense to go ahead and sell Chipotle, take the loss, because reinvesting, albeit lower proceeds than when you started with Chipotle, but reinvesting them in, again, our example, Ford, which is going to zoom up, will end up being the better long-term decision. So the anchoring bias keeps you anchored not just to a certain way of thinking, but it seems to keep you anchored to not looking elsewhere. Your focus is just on, I made this decision, and darn it, this decision's got to turn out to be right.
Yeah. Well, I think we're showing our age differences when I'm using Chipotle and you're using Ford for our stock examples. But
all right,
it's
X, but whatever. You probably didn't get those terms wrong.
Yeah,
you're right.
It's a really good point. I can't determine, what my opportunity cost or really be doing true stock analysis if I'm not looking at the whole market. If I'm not looking at what my other opportunities are, where there could be other growth, it does require a massive amount of research and really ability to just crunch data. Even with advancements of computers and AI, it becomes really difficult for a single person to gather all of that information.
Okay, so let's say that most of our listeners are really, 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 really sharp, and all of our listeners are great, and they're going to be disciplined, and they're going to go about this the right way. Can they do it? Can they gather those resources that you've talked about in order to do this effectively?
In theory, I would like to imagine that anything is possible, but um, it would require a lot of access to. I think actually I've changed my answer. No, I don't think it is possible because you'd have to leverage other people's research and time. There aren't physically enough hours for somebody to read enough of these reports, crunch enough of the numbers to cover absolutely everything. And so you start relying on reports of other analysts or of, stock traders and magazines and different things, some of which is good and some of which is not so great. But it's extremely difficult for a single person to truly do due diligence on every single publicly traded company. It's not possible.
All right. So, listeners to this channel and readers of our blog know that we say you should invest in stocks. And we say you should invest in bonds as well, but we're saying you should also invest in stocks and the right allocation, yada, yada, yada. But now we're saying, but you, the viewer, shouldn't do that. So how does the viewer get stocks picked for them?
Sure. Well, I love investing in stocks. Myself, all my clients, were all invested in stocks.
Right.
Where I think my role as the advisor and me saying, well, a single person can't perform all this analysis, I'd make an argument that even a financial advising firm or a team of professionals, it's too much to cover within one small group, unless you were highly specialized, had very large teams to do so.
So is there a person out there that does, is there a professional or someone with a title that does that?
Sure. So what we leverage and the way that we buy stocks is through the use of professional money managers. So we're using teams of people that use their resources and have hundreds of analysts that are covering global economy, macro trends, industries we talked about, down to the very companies. And they're helping make those buy-sell decisions. And you might have multiple analysts covering a single company, but they're able to delegate that work. And you have professionals that are trained in stock analysis and have tools accessible to them that the average person wouldn't, or they would be too costly for a single person to buy, that can start getting them closer to being able to make these decisions and making them properly.
So it sounds like you're going to have a gazillion dollars in order to get one of these professional money managers or these money managed teams that pay attention to you. Does that mean the average retail investor just can't do that? The average person saving for their retirement can't do this?
No. So the way that we leverage them most of the time is through either mutual funds or ETFs. ETFs and mutual funds have some minor differences, but it probably too long to discuss in this podcast.
But what's the linkage between either the mutual fund or the ETF and this money management or this money management team? What's that?
Sure. So these teams put together by professional money managers, they create funds that buy somewhere between, some may just buy a few dozen stocks within a given market segment. Others may buy hundreds, if not thousands, within a market segment, all depending on what they're trying to achieve. Are these, we've talked about the S&P 500 fund. Are these, I'm going to play within the universe of the S&P 500. I'm going to make buy-sell decisions that are over the long term supposed to give me a higher rate of return. And that's traditionally what we think of when we think of a professional money manager. But there's also the other aspect of the Vanguards of the world, or the iShares, are some of the most popular names of indexers, where their focus is not on picking which of those 50% of the S&P 500 are going to be up this year versus down and trying to find the best one. They're just buying the entire market and accepting that return and their focus is more on tracking error, how close do I stay to my index, and minimizing costs.
So when you say they're buying the index, that means they're doing what? They're buying all the companies that exist inside the index in just whatever percentage they want?
No, so they're buying them. Well, there are some that are equal weighted or mess with those weightings, but your traditional index fund is just going to buy in order of, if NVIDIA is 10% of the index, they put 10% of their money into buying NVIDIA shares,
Okay.
9% into buying Apple, et cetera, until they get to all 500 companies. As a individual investor, that's some research I should do is find out how many dollars it would cost to create your own S&P 500 index. But
Because you got to buy
you would have to
500
buy-
companies
right.
in certain percentages of whatever money you've got at whatever share value there. It could be
Well,
hundreds of thousands of dollars or millions of dollars just to replicate that. If you're doing it on your own.
millions. Berkshire Hathaway alone is, I think, $250,000 a share in the A share class. So you would need a lot of money in order to replicate it.
But for example, ballpark, because you may not have looked it up ahead of time. If I said, yes, I want to play in the S&P 500, and where you play is, I know, is another question, but we're using that as the example because there are a lot of other equity indexes to be considered and put into an allocation. But if we're just saying that, okay, I want to be in the S&P 500, how much do I have to have, looking at these different ETFs or iShares or Vanguards, in order to get that exposure?
$100.
So the price of a share of a index fund or an ETF is going to be in the ballpark of like $100.
Right.
And that $100 is going to be essentially divided up into 500 companies in our example, the S&P 500.
Correct.
That sounds like some pretty good leverage, and I mean in a positive way, not taking on debt.
Yeah.
It's just you can make your $100 get you exposure to 500 companies.
Right. Exactly. And I think that's what's most important. And even if you're not using the index funds, but even a mutual fund, it would be very cost prohibitive for somebody to go in and buy the shares of even 30 or 40 companies. Most people could do that. But in order to do that in all different segments of the market, it's really difficult to get a well-diversified portfolio without leveraging funds, whether you do it in the active space or the index space.
Okay. Now, stepping away from just the S&P 500, because it is one of those big, broad measures, although you said it's not the broadest by any stretch of the imagination, because there's 40-some thousand stocks out there. So quickly, without getting into the details of actual percentages, what indexes typically would you say a stock investor should expose themselves to?
Sure. So S&P 500 is really a barometer for the 500 largest companies. We like to be a little bit more granular and look at both large cap growth and large cap value companies. Primary difference being the growth companies are your fast growers. They're the ones that you're willing to pay a little bit more to buy a share of their stock because they're expanding their market share. They have new technology. The upside's higher.
Okay. So that's growth, that's value.
Value is going to be more your banks, oil companies, Coca-Cola, companies that have been around for a really long time.
And there are indexes for each of these. So there's a growth index, a large growth index, there's a large value index. That's just two. What other else would you say you should expose to if you're going to be in stocks?
Well, if you talk about stocks, there's also thousands of different ETFs and mutual funds as well. So just selecting within those requires some work to do.
Okay.
And so you started today's conversation with, well, how do you pick stocks? What I do is I pick those funds, those index funds, or active mutual funds that I think in these categories are going to give me the best rate of return going forward.
Okay. The categories, though, you would expose yourself
Yeah.
to or expose a client to, they would be,
So we talked about large growth and value.
Okay.
It's important to have small company exposure as well. We want to see overseas,
Okay.
both developed and emerging market exposure.
4 or 5. Okay. Now,
We use real estate as some would argue that's not an asset class. It's more of a sector.
okay.
But we think it zigs and zags a little bit differently than some of the other stocks, has different return characteristics, and we think helps with creating a balanced portfolio. So
All right. So each of these now, and if the S&P 500 is the S&P index ETF or index fund is a good measure of this, you get in for $100. If you're needing to expose yourself to like five of these indexes, it sounds like for as little as maybe $500, $600, you could be broadly exposed to all different categories: large growth, large value, small cap international, and real estate.
that's correct.
Wow. And then all that's left is to let that roll, because these are all professional money managers no longer working against you, right? You're not having to compete with these guys and get all
Yeah.
those resources that you said might theoretically be possible, but would consume all the hours of your day. You're basically saying you guys are already doing it, or gals doing it, shouldn't be pejorative about that. But here's my money. You all invest that and give me the exposure that I need, and I'll go do whatever else I do in life.
Sure, and a lot of these indexes now, it's because the primary driver for their returns is tracking error and cost. It's been a little bit of a race to the bottom, in that you can get this stock market exposure for like 0.4%. So 0.04.
0.04%.
Exactly. So when we're talking about investing $100 in a fund with 0.04% cost share, you're spending 4 cents. Is that
On a buck. No.
4 cents
cents,
on $100
$100.
invested to have somebody professionally moving? Okay, well, this bottom feeder stock is now no longer in the S&P 500. These three have come up into it, reconstituting that. There's trading. The way that we trade on Schwab or Fidelity or E-Trade is retail investors. There's spreads where we're paying a little bit of profit to those brokerage houses every single time. Institutional money managers that are moving billions of dollars each day, their margins are a lot thinner than ours. So with our 0.04%, we're getting all of that expertise. We're getting diversification.
So for $100, my choices are to keep all $100 and try to compete with all the professional money managers out there, or spend 4 cents of that $100 to get some or all of those teams out there to work on my behalf.
Yeah, and one of the things that professional money managers actually look at is retail flows, and that's usually something that they'll go contrary to. When a lot of retail investors are pouring money into something or short selling something, they'll go counter that. When it's your own money and when you have emotions involved and trying to make your own decisions,
Figuring that the herd is more often wrong than the herd is more often right.
exactly.
All right.
So
we started off asking the question, how do you pick stocks? And you gave a pretty good technical answer as to what that process needs to be and what you look at. But I think where we're ending up is you're saying, but don't try to pick individual stocks.
yeah, well,
Let someone else do that for you.
I as far as a tried true systematic process, I wouldn't recommend it for the majority of somebody's net worth.
Okay.
It's taking on a lot more risk. You're getting less diversification, and history has shown us that a lot of the time you're getting inferior returns too with taking on more risk. And so just natural portfolio theory is we want to maximize return with the lowest amount of risk possible. And it's hard for me to believe that as a retail investor, or, I'm a professional in this space as well, that I could go and do that successfully on my own.
Okay. Well, that sounds like a pretty good place to leave it. And you've heard from someone who, again, is got decades of experience as an advisor, certified financial planner, is on the investment committee, and even in his own portfolio, he's not trying to pick the stocks. This is the fool's errand. Let the professional pick the stocks for you. Leverage that skill, leverage the resources they always have. And we can schedule another time to talk about how do we actually go about picking those professional managers the most efficient way and deciding what that split is between growth and value and small and international. But the answer to the question is it's possible to figure out how to pick stocks, but don't try to do it. Don't do this at home, as they say. Anyway.
That'd be my professional advice.
Perfect.
All right.
Thanks for participating. We enjoyed it.
Yeah. Thank you.
All right. Thanks for listening, everybody.